Is the Canadian commercial real estate market truly facing its most challenging period yet? With a 24% drop in investment volume in the first half of 2025, it's a question on every investor's mind. Welcome to the Multifamily Real Estate Insights podcast. I'm your host, Sandy McKay. Let's get right to it. Today, we're diving into the latest developments in Canada's commercial real estate market, as highlighted by Jennifer New and Ray Wong. The first half of 2025 has seen a significant contraction in commercial real estate investment activity, with total investment volume reaching $19.6 billion, a 24% decrease compared to the first half of 2024. This decline is largely attributed to geopolitical tensions with the United States and a static interest rate environment which have fueled investor uncertainty. In Ontario, and particularly in cities like Hamilton, Niagara, and the Greater Toronto Area, the multifamily sector has not been immune to these challenges. The sector experienced a 13% reduction in year-over-year investment volume. This volatility is partly due to changes in immigration policy, which have slowed population growth and subsequently affected demand for housing. Despite these headwinds, there are still pockets of resilience. The retail sector, for instance, recorded a 5% increase in investment volume, buoyed by strategic investments in food-anchored retail strips and properties with redevelopment potential. This shows that investors are actively seeking stability in necessity-based retail formats, even amidst broader market challenges. The industrial sector also faced a tough first half of the year, with a 29% decline in investment volume. However, in the Greater Golden Horseshoe, investment volume actually grew by 3% year over year. This indicates a strong belief in the region's market fundamentals, despite rising availability rates elsewhere in the country. Looking ahead, the Canadian commercial real estate market will likely continue to adapt to these shifting dynamics. Investors are becoming more strategic, focusing on asset classes perceived as more stable, such as food-anchored retail and multifamily properties in areas with robust market fundamentals. Calgary's multifamily sector is currently drawing significant attention from institutional investors, with real estate investment trusts and private developers expanding their holdings and pursuing large-scale rental projects. According to Avison Young's Fall 2025 Calgary Multifamily Overview, zoning reforms introduced in August 2024 have accelerated the development of middle-density housing, making it easier for new developments and conversions to enter the market. Demand is still there for Calgary product, said Haig Basmadijian, Associate Vice President of Multifamily Investment Sales at Avison Young. Buyers have and will continue to identify Calgary as a major market for entrance and expansion, encouraging transactions and development in the space. Development in Calgary has been clustering around urban centers such as the Beltline, East Village, Bridgeland, and Mission. These areas are benefiting from revitalization projects, mixed-use amenities, and future connections to the Green Line transit expansion, according to the report. Suburban districts in the southeast and southwest of Calgary remain tight, supporting resilient rents despite a broader market slowdown. Mason Thompson, Associate Vice President of Multifamily Investment Sales at Avison Young, noted that Calgary's multifamily market has firmly established itself as one of the country's most attractive investment environments. Institutional capital and private developers alike are scaling up activity, driven by favorable zoning reforms that are unlocking middle-density housing and supporting new rental supply across key nodes. The report also highlights shifts in financing and market stabilization. While investment sales volumes in 2025 are on track to nearly match last year, average sale prices have moderated after 2 years of rapid increases. Tighter financing requirements from Canada Mortgage and Housing Corporation, including higher insurance premiums, are reshaping buyer strategies. Financing has become more complex under new CMHC rules requiring sharper underwriting and pricing discipline, yet sales volumes remain on pace, Thompson said. Older buildings constructed before the 1990s are gaining popularity as investors target repositioning opportunities and higher yield potential. Meanwhile, newer post-1990s inventory faces pricing pressure as rent growth stabilizes. Despite modest increases in interest rates and bond yields, lenders remain active in the multifamily space. Brennan Yadlowski, principal and managing director of Calgary, Alberta, added that the possibility of a Bank of Canada rate cut before the end of 2025 could create momentum for acquisition financing of multifamily real estate. Population growth through interprovincial migration, coupled with economic opportunities and resilient fundamentals, continues to support Calgary's rental market. As Thompson emphasized, the market is maturing into stability while retaining robust long-term fundamentals. Other key findings from the report indicate that Calgary rents have stabilized around $2,000 per month across unit types after several years of sharp increases, offering more predictability for both landlords and investors. New supply is entering the market at a pace comparable to 2023, with developers increasingly allocating portions of projects to below-market rental units to access funding incentives. Vacancy rates have risen slightly due to the surge in completions, but remain manageable, with affordability pressures continuing to drive demand for a mix of market and subsidized housing. Year-to-date, 2,169 units have sold, with 39 rental developments under construction and 68 more in proposal stages. In other news, the Marwest Apartment Real Estate Investment Trust has announced its monthly cash distribution for September 2025. The trustees of the trust declared a cash distribution of 0.001425 Canadian dollars per trust unit for the month of September, which translates to 0.0171 Canadian dollars on an annualized basis. This distribution will be made on October 15, 2025, to unit holders on record as of September 30, 2025. The Marwest Apartment Real Estate Investment Trust is an unincorporated open-ended trust governed by the laws of the province of Manitoba. It offers unit holders the opportunity to invest in Canada's multifamily rental sector, focusing initially on stable markets throughout Western Canada. The trust is managed by a team with over 100 years of combined experience in multi-residential real estate. Their expertise spans development, construction, management, and financing, providing a robust governance framework. The Marwest Group of Companies, a fully integrated real estate group, manages the assets and properties of the trust. With a history of developing over 12,000 units and managing over 2,500 units, the Marwest Group brings a wealth of industry knowledge and strong relationships to the table. This collaboration ensures that the Marwest Apartment Real Estate Investment Trust continues to benefit from top-tier tools and infrastructure. As always, it's important to note that forward-looking statements, such as the Trust's current monthly cash distribution policy, are based on assumptions subject to significant risks and uncertainties. The actual results may differ from those anticipated, depending on various factors like the financial performance and condition of the Trust. However, the management believes that their expectations are reasonable, though there are no guarantees. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, Sandy McKay. See you on the next one.